What's up you guys, it's Arihant here, and in today's video I just want to talk about a few of the funds that Vanguard offers which you can invest in to earn a good dividend income. I'm doing this video as I got a few questions on this, so stay tuned if you want to find out more. I'm doing a follow-up video on how you can build up your own portfolio of income stocks if you like. I know some investors don't prefer to have stocks like these because they don't like the companies which are in these particular funds. So if you want to build up your own, I will sort of go through in the next video as to how you can do that. And so stay tuned if you want to find out how you can start investing for income from Vanguard. This can also be a source of passive income for you, like I talked about in my most recent video, link to which can be found in the description below. This is the FTSE All World High Dividend Yield ETF and trades for about £37.95. And just look at sort of the distribution of this fund. It pays about 4% annually, so it gives out a payment every quarter. So every 3 months you get a payment from it. 4% you might think doesn't sound like a lot, but remember the banks at the moment are paying 0.05%. So 4.09% is actually quite a good deal. And if we look at sort of what kind of companies this fund holds, so just looking at this, we've got a lot of big companies there. So we've got Johnson & Johnson, we've got Nestle, JP Morgan, Procter & Gamble, and some others that you may be aware of. And altogether there's a lot of them. There's you can see there's over 1,600 pages, and each page has some form of large multinational company, and they all provide dividends, and it's very diversified. As a result, even if one of these companies, let's say British American Tobacco go under, you're only losing 0.5% of your investment. You still have everyone else, and it's also convenient. Imagine having to try build up this whole portfolio of all these companies by yourself. You would probably end up clicking a lot of time and spending a lot of time buying these companies. It would be very inefficient. And just to get a total idea, how many does this fund have? It's got nearly 17 over, or I should say over 1,600 stocks. So that would take a long time for you to buy on your own. As such, having this fund, with one investment, you're investing in all these companies at the same time. So it's quite convenient. And the ongoing charge is not too bad. It's 0.29%, a little bit higher than the usual, but again, that's what it is. You can have a look at the key investor information document. So it's also known as KID. So if you just click on that, and it will tell you more about the fund. So you can have a look here as to what it does. So it's passive management. So again, it's indexing, and it tracks this particular index. So FTSE All World High Dividend Yield Index. And it's mainly of large and mid-sized company stocks, and doesn't include real estate trusts. And they are generally look for companies that pay dividends that are generally higher than average. And there's the risk profile. Yeah, that's pretty much it. It tells you a bit about the charges. So it's just 0.29% over a year, and everything else is there's no other charge for it, which is great. Gives you a little bit of history about the funds, how it did over the years in terms of growth of your cash investment. So that if you invested £1,000 here in 2014, it probably went up by 1.2%. Then it would go down by 5.2%. Then it would go up the same amount by 10.6%. Then up by 19%. Then down, then up, and that's how it sort of works over the years. Just close that. So that's one particular fund, and you can see more information here. So we go into, that's all of it. So yeah, if you invested £10,000 here, would have gone slightly down, then up, down, and here would be roughly, today would be worth about 10,455. That does not include the dividends you would have received in this time. So if you had received dividends, that's not shown on this graph. That's just the value of your cash investment. Of course, we are in extraordinary times. If it was sort of normal trading, it'd probably be somewhere around here. So it'd be about just under £13,000. So that's 30% return in 5 years, which is not bad at all. Let's look at another fund. So we've got the Global Equity Income Fund. So again, you've got income and share classes. You can go to income, which is going to pay out an income to you, and it's roughly £120 a share, and it contains 137 stocks. Here, I think this is an active fund, so its fees are much higher, nearly 0.48%, and it pays a dividend quarterly. So just have a look at the distribution here. So you've got quarterly, and it's 3.55%, and it works in pounds rather than dollars, what we've been seeing so far. So this is more of a UK based one, and here you've got 67 pence for every unit or every share that you have of this particular fund, and it's been paying for so many years. You can go back and sort of gives you more information about since where you want to find. So let's say you go back to April, put it there, and it tells you, yep, so it's been 2019. It's been paying consistently, which isn't too bad. So let's just have a look at when the fund was established. So it started out in 2016. Okay, that's when it started out. And in terms of what companies it has, it's got again Microsoft, Pfizer, Taiwan Conductors, etc. And yeah, you can just sort of flick through and see what companies there are. But again, it's nearly 140 companies, so it's quite diversified, which is pretty good. So that was the Global Equity Income Fund. Costs, I'll just quickly go through that. So you've got 0.48% cost, minimum £500 investment. So yeah, remember you have to pay a account fee to Vanguard as well, which is I think roughly 0.15%. So that would push this up a little bit higher. So yeah, just bear that in mind. Then you've got the FTSE UK Equity Income Index Fund, which is equity, so it means it's mainly stocks and shares. And as an index fund, its fees would be a lot lower. So here you can see immediately it's in the previous one it was 0.48, and here it's 0.14. Again, it's a lot cheaper. That's why I sort of prefer index funds, because they let you keep more of your investment. It's also got 125 stocks. This one had 137, so it's not much of a difference, to be honest. And in terms of price, it's very similar. This is £222, the index fund, and here this one is £120. So of course, okay, it's a bit more expensive, but if you just go into the income one, yeah, it's very similar. So if you compare income funds to income funds, this is 120 and this is 133, so it's not too bad. Just sort of look at the distribution here. Again, the distribution is very good in this, over 6.5%, but it's semi-annually, so it means it will pay a dividends twice every year. So 2 times during a year. So last year it was in May and November. Before that is again November, May sort of, and it's got a history going back to 2015. Just look at portfolio data. It will have, so it's mainly exposed to, it's mainly based in Europe, specifically all of it's in the UK. It sort of gives you a breakdown according to sectors. So financials is the biggest, then you got basic materials, etc., etc. If you just look at, we've got Rio Tinto, we've got British American Tobacco, GlaxoSmithKline, BP, National Grid. Again, a large number of British companies. Royal Dutch Shell, Barclays, good dividend payers, and yeah, so quite diversified. Now, in terms of pricing performance, again, the market's been very volatile, so it went down a significant amount yesterday. If we just sort of look at it in terms of your investments, so since inception, so let's say you had invested £10,000 back in May 2009 into this fund. Today, that £10,000 would be worth £21,417, roughly, and that's quite good. Again, because the market has dipped in the past 3 months due to COVID-19, it would probably be somewhere around 27.5, call it 27,600 ish. So that's pretty good. Plus, you would be getting that dividend yield as well of 6.5%, which is amazing. Of course, that dividend yield might not have been there for the previous years, but it's there now. I don't know what the history of that is. You will have to look that up. But again, it's quite good. Plus, it's quite low in terms of costs. It's just 0.14%, which is fantastic. And then it's going to go over here. So that's that. No entry charge, no exit charge, and again, you have to start with minimum £500 investment. So, so far I've just talked about sort of stocks and shares funds, which have mainly stocks and shares. I know some of you might prefer bonds. I'm not too keen on bonds because of the very low interest rates. They don't tend to pay a very good yield, but I'll sort of just cover them quickly anyways. So here you've got UK gilts. Gilts are just another way of saying bond. So whatever treasury, the UK treasury that issues sort of bonds, they're called gilt rather than bond. That's just how it is. And just look at this one. Again, it pays a very low yield. It's just 1.27%. Because it's a bond, it tends to be very safe, and hence you tend to get a very low yield. Now, and it's also quite diversified. So if we just look at portfolio data here, it's got all UK gilt or bond, and again they mature at a different time. I'll do a separate video on bonds and sort of explain how they work, but essentially bonds have a set life. So some will, for example, expire in 10 years, some will be 20, some might be in 1 year, some might be in 2 years, and they vary. And they tell you the rate here, so you can see this one, it will expire in 2068, and it pays 3.5% interest. This one pays 4.25, this one's 3.25, etc., etc. And they all have their expiry date. So that means up to that particular point, it will keep on paying that much interest. So if you bought a gilt at £100, you would get £4.25 per year till 7th of December 2046. And this percentage here is basically how much of this fund is made up of that particular gilt. So this fund has 3.89% of this particular gilt, and yeah, that's how it goes. Now, I didn't mention the price, but it's roughly £26.59 to buy this particular bond. And again, the transaction costs are very low because it's an index. I think it's a passive. Yep, it's an index strategy. As a result, it's quite low. We just have a look at the key investor document, KID, and again, it tells you it's passive indexing and it tracks this particular index. It's slightly lower risk because of the fact that it's bonds and gilts, but again, and here it's got charges, so no exit or entry charge, which is good, just one fee, which is very low in itself. So that's that one. And yeah, any questions about this, drop in the comments below, and I'll answer them.